In this video, I walk through an illustration of a fixed income arbitrage using the example assigned to FRM candidates, which is Bruce Tuchman's tables 1.2 to 1.4. So my workbook replicates his replicating portfolio, pun intended. We'll see there are 3 steps. Each of the 3 steps is on one sheet of my workbook here. The first step is the observation of a series of U.S. Treasury bonds that informs a discount function. The discount function is the series of discount factors. The law of one price says there is only one discount factor at each maturity. Second step is the opportunity. We observe in this case a 1-year bond that is trading cheap. That means its traded price in the marketplace is lower than the price we get when we use the discount factors to compute its theoretical price. That discrepancy, lacking any friction and confounding factors, is the opportunity for the third step, which is the arbitrage. In this case, we construct a replicating portfolio that replicates the cash flows of our bond that's trading cheap, so the future cash flows are identical, and then we simply buy the thing that's trading cheap, our bond that we observe to be trading cheap, and we sell the replicating portfolio, in this case pocketing a profit of 6.5 cents per face value on the bond, but the future cash flow streams are perfectly neutralized to 0, so it's an immediate risk-free profit. It's therefore an arbitrage. 6.5 cents sounds like not very much. Tuchman reminds us that that could be leveraged up to a profit of over $300,000. Okay, so now let's take a look at these 3 steps. So the first step here is just the observation of the term structure, or what we could call the theoretical term structure of spot rates, presumably risk-free because it's U.S. Treasury bonds. I've replicated Bruce Tuchman's example, so it's as of May 28, 2010. And by term structure, I just mean that we have at 6-month intervals here, 6 months, 1 year, 1.5 years, Treasury bonds with their coupon rates, and then we observe prices. So these are observed prices, which means I'll color them yellow here just to signify that they're inputs. We're not solving for these prices. With this set of observed prices, I've covered in a previous video how we could construct the discount function. Right, the discount function is just the set of discount factors that are implied by these traded prices. And the law of one price says that, right, absent confounding factors like credit, risk, tax, etc., there is only one discount function, or more specifically, at each maturity, there's only one discount factor. Recall, the discount factor is very convenient because it allows us to multiply a future cash flow by the discount factor to get the present value. And in a previous video, I said that discount factors don't lie because they already incorporate the compound frequency information. So this first step here takes these observed prices to inform the discount function or set of discount factors that would allow us to compute the present value of any bundle of cash flows, and bonds, after all, are just bundles of future cash flow streams. Okay, so with that first step then, the next step in Tuchman is the observation of a discrepancy, and that's table 1.4, also of the same date. So now we have 3 different bonds, but I'm just going to highlight a 1-year bond here. This bond is different than the 1-year bond in the previous table that informed the discount function. This bond has a 3/4% or 0.75% coupon. And if we use the discount factors to price it as we normally would, its theoretical price is $100, 0.255 or about 25 cents. And the opportunity is that we observe in the marketplace, it has a traded price of $100.19. Right, so the traded price is about 6.5 cents less than the theoretical bond price. And so we say this bond is trading cheap. And for example, the 1.5-year bond is also trading cheap by about 6 cents as well. The 6-month bond is trading expensive, which is to say its traded price is higher than its theoretical bond price. And so this introduces an important conceptual distinction, right, between theoretical bond prices that we could also call model prices, computed as if we were to present value the cash flows, as we often do, model prices as opposed to market prices that are observed and their discrepancies. And so the arbitrage opportunity creates itself because we have a bond here that is trading cheap by about 6.5 cents. Its traded price is less than its theoretical bond price. This creates, in theory, an arbitrage opportunity. Before we do that, let's just acknowledge that we don't expect them to be exactly the same. There are actually several confounding factors like liquidity. So we will observe discrepancies. Further, it's not free to conduct the arbitrage. There are transaction costs. So the fact that confounding factors exist and that we do incur some cost to exploit the arbitrage opportunity implies that we should expect some trading cheap and trading expensive activity, but it shouldn't get too far out of hand. So then this is the Tuckman's table that shows how we exploit the arbitrage opportunity. It looks a little worse than it is, trust me. What we have here in the final column that I've highlighted in orange is our bond that's trading cheap, right? It's a 0.75% coupon bond. It's maturing in 1.5 years, right? Recall, we are conducting this as of May 28th, 2010. This bond that's trading cheap matures 1.5 years later. So that means it has 3 cash flows. In general, throughout Tuckman, and a safe default assumption is that bond coupons pay semi-annually. So this bond that's trading cheap matures in 1.5 years. It has 3 cash flows, a coupon in 6 months, a coupon in 1 year, and a coupon plus return of the principal in 1.5 years, right? The 37.5 cents is simply the 0.75% coupon multiplied by the face amount divided by 2 because it's paid semi-annually. So there's the bond that's trading cheap, and we know we're going to buy the thing that's trading cheap in the arbitrage, and we're going to construct a replicating portfolio that will be expensive in comparison, and we'll sell that replicating portfolio. So the whole exercise here, the idea is to construct the replicating portfolio that exactly replicates the cash flows of our bond. And we know that if we use the securities that we originally observed in the marketplace, that the cost of this replicating portfolio will be the theoretical price that we would expect from this bond. Specifically, in this case, it's going to be $100.25. So our replicating portfolio is going to have a higher price, and so we're going to be able to sell the expensive replicating portfolio, purchase the bond that we observe to be trading cheap. We'll immediately have a profit of 6.5 cents. We can pocket that immediately, and then what we're facing with is a long and a short position in bonds that exactly offset. So this is the definition of an arbitrage. We don't have to wait for a thesis to play out. Immediately, we generate a riskless profit. The difference between the cheaper bond that is trading cheap that we purchase, we sell the replicating bond, pocket the difference, and the cash flows on one bond exactly offset the cash flows, so the future cash flow streams are net zero. So how do we do this? Well, we have these 3 bonds. We're going to use the 3 bonds going back to now, just to show you on the first tables 1 and 2 that we showed. These are our assumptions, the U.S. Treasury bonds that trade in the marketplace, right? Here's a 1.5-year bond, 4.5 coupon. So we're using that bond or those three bonds to replicate. So we start with that final cash flow, 4.5% bond. And the question is, how much of this bond do we need to replicate or match exactly the cash flow on our bond that's trading cheap? That final cash flow on our bond that's trading cheap matures in 1.5 years. It's $100 at 0.375. So the idea is that's the cash flow we need from our replicating portfolio. Replicating portfolio contains three bonds, 6 month, 1 year, 1.5 year. We start with the 1.5 year because this is the only bond in the replicating portfolio that will deliver a cash flow in 1.5 years. If we purchased $100 of face amount of this bond, of course we would get 100 plus half this coupon, or $2.25, which would be 102.25, which is more than we need to exactly replicate. So really the math is just that we want the face amount of the 1.5 year bond multiplied by 1 plus the 4.5% coupon divided by 2, right? So this is the future cash flow. However much face value we buy of this bond, here's 1 for the par or principal plus half the coupon. So that's the final cash flow of this bond. And what we need is that to equal the $100.37.5. That's the idea. So that means that the amount of face amount of this 1.5 year bond that's part of the replicating portfolio, in order to deliver in its final cash flow $100.37.5, the face amount that we need is 100.375 divided by 1 plus 4.5% divided by 2. And that solves for this amount right here. That's the face amount. And you can see intuitively, hopefully it makes sense, it's a little bit less than the face amount, right? If we bought the 100, we're going to get a little more than we need. So the face amount that we need turns out to be $98.17 of the face amount, and that will give us exactly $100.37.5, which is the only cash flow in the replicating portfolio, and that matches the trading cheap bond that we're trying to replicate, right? This replicating portfolio is replicating these cash flows. So it's informed by matching these two values in this case. And if I go back here and just show you the cell, that's exactly what I've done in Excel. I take the $100.37.5 and divide by 1 plus 4.5% divided by 2. Okay, now the issue, then working backwards in time, now the issue is how much of the 1 year bond do we need? This is the 1 year bond in that first set of a table that we looked at. It has a coupon of 4 7/8, matures in 1 year from May 28, 2010. And so what we need here is we need to replicate the 37.5 cents. And the question is how much of this 1 year bond. But the difference this time is we already know how much of the 1.5 year bond that we purchased, this face amount, and this face amount is going to produce $2.21 about of cash flow. We only need 37.5 cents. So the solution here needs to acknowledge this cash flow and says, okay, the face amount of the 1 year bond that I need now multiplied by 1 plus 4 7/8 coupon. 4 7/8 coupon divided by 2. Plus the 2.209, right? However much face value of this bond is going to give me this much cash flow, but I'm already I already get $2.21. I need that amount to equal 37.5 cents, meaning the amount of face value of the 1-year bond that I need is my 37.5 minus 2.209, and I divide that by 1 plus 4.875% divided by 2, and that's going to give me this face amount here, which is negative, meaning if I'm purchasing this bond, I'm selling this bond or issuing this bond so that in 1 year I actually have to pay this coupon, which is which is fine because I'm receiving $2.21. I'm paying this, and the difference here in my replicating portfolio exactly equals 37.5 cents. So again, the motivation here with the solution is to with the replicating portfolio match my 37.5 cents. Given that I'm already purchasing this face amount of the 4.5 coupon bond, I've now solved for how much of the face amount of the 1-year bond that I need to purchase in order to deliver the correct 1-year cash flow, and it turns out to be a negative in this case, so it turns out to be a short. Okay, and then that leaves only the final step here, and I'll just zero this out and just recreate this so we can walk through it. Using the same logic, I'm not going to do the algebra again because the pattern's going to be the same. Using the same logic, I know that this is now a 6-month bond. It's the only remaining cash flow I need to replicate. I know I'm replicating the 37.5 cents. However, I'm already getting, right, this cash flow by virtue of the 1.5-year bond that I've purchased. I'm already getting this cash flow by virtue of the 1-year bond that I've purchased, but it's negative because I'm selling it. And I divide that by 1 plus the coupon here divided by 2. And in this case, for the 6-month bond that's part of my replicating portfolio, I also end up with a short so that my cash flow in 6 months as part of the replicating portfolio, which is now all 3 bonds, right, includes this negative amount that I'm going to have to pay as part of this amount that I shorted, and this negative amount that I have to pay as part of this bond that I've shorted, plus this amount that I'm going to receive as part of this bond that I've purchased. And so the net cash flow in my replicating portfolio equals 37.5 cents, and by design, by intention of the whole exercise, equals the 37.5 cents in the bond that I am replicating, the bond that's trading cheap. And so that's the idea. Just to recap, column 6, here's the bond that's trading cheap, right? Trading cheap. We construct the replicating portfolio, and that we know is going to have a higher price due to the law of one price. Its total price of the replicating portfolio will be $100.25. So we purchase the bond that's trading cheap. We sell the replicating portfolio for the higher price. We can immediately pocket the difference of 6.5 cents, and the future cash flows are net zero, ensuring our arbitrage. So that means on the replicating portfolio, this is the thing that's more expensive, so we sell it, and that means that we are selling the 1.5-year bond or issuing that bond, and we are purchasing the 6-month and the 1-year bond, right? So when we get to, let's say, after we conduct the arbitrage and we go forward 6 months on the first coupon date, we're really going to collect this amount from these 2 bonds that we purchased. We're going to pay this amount on this bond that we sold so that we're paying 37.5 cents on the replicating portfolio that we sold. And we get that from the exact same 37.5 cents on the trading cheap bond that we purchased. And that'll the same dynamic in 1 year. Our cash flow that we receive on the trading cheap bond that we purchased exactly funds the cash that we need to pay. And the final cash flow here that we receive exactly funds this amount that we need to pay. We're net zero on the future cash flow streams, but we locked in on day one the 6.5 cent profit. So that's the idea. If the video was helpful, subscribe to the channel and we'll make sure you get notified of the next one. Thank you.